All right, good morning, investors and traders from around the world. Welcome back. This is our weekly video brought to you by Finom Group. And as usual, I am your host, Seth Golden. And we haven't done a video in a couple weeks. I thought it would be a good time with indices hitting record highs to kind of go over where we are, see, see what the path is for markets possibly going forward. I know a lot of investors, traders, analysts, strategists, pretty much everybody, every market participant has some degree of uncomfortability right now with what has transpired in markets over the last, let's call it 3.5 months. As we travel through this new calendar year, which is an election year, we always have to keep the cycle in mind. The 4-year presidential cycle. This is a election. It's not just an election year. It's actually a re-election year. I would encourage investors when they come across data, charts that reference election year, that you kind of narrow your parameters down to recognize it's not just an election year, it's a re-election year. And re-election years have different patterns, although not terribly different than an actual election year. The difference being that we have a sitting president, running for re-election versus an open field, as they say. So with that, almost everything that you really want is just outside your comfort zone. Get comfortable being uncomfortable, especially in the markets, folks. So let's dive into some of this week's data and analyze, what are the probabilities going forward for markets, for the economy, and take a look at, what is also the sentiment around the market. A lot of market participants, we'll look at some of theirs. We'll also, travel back in time, which is what we're going to do here with this first graphic, or composite graphic of headlines that we saw going into 2023. Not this year, but last year. So David Tepper is leaning short on the stock market into 2023 because of global rate tightening. How'd that work out, right? I mean, pretty much from the first trading day of the new year in 2023, the market started to rally pretty significantly. We even had breath thrust fire in January of 2023. Liz Ann Saunders going into 2023. So in December of 2022 going into 2023, it's rare but not impossible to see negative stock market returns for at least 2 years in a row. S&P 500 suffered back-to-back declines in a handful of instances, more recently during the tech bust. Now, it's possible that we could have had down, back-to-back years, but this is Liz Ann Saunders' way. I mean, she's basically a perma bear in a strategist, cloak, if you will, but she's always looking down. How'd that work out in 2023? All right, fast forward, basically to the tail end of 2023, Morgan Stanley's Mike Wilson, who's their chief equity strategist, sees year-end stock rally as unlikely. Now, I'm old enough to remember, the fourth quarter of 2023. Did we have a stock market rally? We absolutely did. Nobody knows anything, folks, okay? Nobody knows what's going to happen next in the stock market, but they're more than willing to give you their outlook for free. Yeah, they say you get what you pay for, right? If you're not paying anything, it's probably not worth anything. But these are, Wall Street strategists, big hedge fund managers. Don't read into the headlines. Nobody can predict the future, folks. Don't care, how many billions they're managing, or what the nameplate is on their Wall Street office. All right, so with that, let's move on. A lot of talk over this past weekend about Jeff Bezos, selling, I don't know, $1 billion worth of his Amazon stock. By the way, he was selling stock in 2021. If you remember the headlines back then, his divorce and all kinds of stuff going on, home purchase, whatever. But, you know, in social media and headlines will lead you to believe that this insider trading, insider selling especially, holds some kind of signal for the future of the stock price, right? Oh my gosh, Jeff Bezos is selling his stock. That must mean there's problems at Amazon. Late last year and over the last 2 years, Mark Zuckerberg continues to dump Meta shares. This is from Bar Charts. This is their post. And this is, let's see, January 25th, 2024. And what has happened to Amazon stock, right? And it just lifted off, right? So market participants are, you know, far too often they're of the opinion that for every yin, there's a yang in the market. For every, you know, every action, there's an equal and opposite reaction in the stock market. It just does not work that way. I get it that it just sounds very balanced. But that's not how the market works. The market goes up 75% of all years, not 50%, which means it would go down 50% of years. There's not an equal and opposite reaction in stock market. I'm sorry. It's not the way it works. So when people see these headlines about insider selling, they equate it to, you know, having the benefits of insider buying, except, you know, opposite, obviously. Mark Zuckerberg, you know, these are sales going all the way back to 2023, folks. December of 2023. The stock is up another 20% since then. Insider selling is not a signal. Most of the time, insiders have what they call a 1040B plan. And essentially, that's scheduled transactions, scheduled sales. And they can happen for any number of reasons, most of which have nothing to do with the corporate operations. Now, insider buying does have a signal historically. Historically, insider buying is actually a signal of what insiders think of their future potential in the company, or the future potential of the company, I should say. Again, this is why people think, you know, well, if there's a signal from insider buying, there must be a signal from insider selling. It just doesn't work that way in the stock market. Again, you know, here's a chart. I'll blow it up a little bit here. This is the insider sell to buy ratio, this middle line here. And if we go back, we can see here in 2013, at that time, and this data goes all the way back to 2008, yeah. But at that time, you had the highest insider sell to buy ratio in history, meaning more selling than buying from insiders. The highest in history back in 2013. What happened in 2013? Well, the S&P 500 rallied. I think it was 29% for the year. Fast forward, here's another very elevated reading in 2013 also. So two of the highest readings in history to 2013 found the market going exceptionally higher. Well, what happened in 2014? Is there a lagged effect? Well, the S&P 500 gained double digits in 2014. Fast forward, we'll go out here to 2019. Again, what happened in 2019? High insider sell to buy ratio. The S&P 500 on a total return basis in 2019 gained 31%. 2020, granted, insider sell to buy ratio was also elevated. COVID. I mean, there's not much you can do about that, folks. 2021, the next highest insider, and this is January, by the way. Okay, February. We'll call it February. No, I'm sorry. Yeah, that's the first month on the second day. Insider sell to buy ratio, highest in history. For those of you who remember your market history, 2021 generated a 26% return in the S&P 500. There's no signal from insider selling. However, there is a signal from insider buying. Now, this doesn't mean Amazon stock can't go down because Jeff Bezos is doing this or Mark Bark. What it means is that it has nothing to do with the insiders are doing when it comes to selling their stock. All right. Another aspect of the markets that people think that, if if leverage is too high, that must mean the market is about to roll over. Active manager sentiment, and this goes back to June of 2023. This is from Urban Carmel, the Twitter handle there. Active manager sentiment, or the NIME exposure index, hit 90 this week. Could S&P 500 quickly roll over? Yeah, sure. Is that what normally happens? Nope. Just because people have a lot of exposure to the market doesn't mean it's going to necessarily roll over. Fast forward 1 month, S&P 500 rallied 7% after it hit 90. And that particular week, it was at 99. Again, case in point. There's just because something is at bullish extremes doesn't mean the market's about to roll over. Bullish extremes are not symmetrical, or they're not the symmetrical opposite of bearish extremes in the stock market. It just doesn't work that way. One is a reliable signal. Bullish extremes tend to be a reliable signal, and the other one is not. Bearish extremes are not necessarily. For only the 6th time since 1959, not a single, and again, look at the date, May 13th, going back to last year. Like I said, we're going to be looking at some market history to identify signals. So May of 2013, for only the 6th time since 1959, not a single S&P 500 equal weighted sector is showing a positive relative trend score versus the S&P 500, meaning that most sectors, in fact, all sectors at that point in the year last year, were underperforming the S&P 500. However, similar periods with narrow market leadership, how often have you heard that phrase over the last year and into the new year, have not foreshadowed a doom and gloom scenario for the S&P 500 over the medium-term basis. Again, as we all know, it didn't mean doom and gloom over the longer-term basis as we gained 25% in 2023. S&P 500. NASDAQ was up nearly 50%. All right, so now here's something that I've been highlighting to our Finom group members inside the trading room basically for the last couple of weeks, and it is the Hindenburg omen. Last week, we actually had the first Hindenburg omen triggered in this new bull market. What is the Hindenburg omen? Well, it consists of 3 conditions. And all 3 conditions have to be present in order to trigger a Hindenburg omen. And that's essentially what the chart shows. You can have 0 showing, which is why it's all the way down here. You could have 1 showing, which is why it would be here, right? 1 condition within the Hindenburg omen showing. This is an NYSE reading, by the way. You can have 2 showing or all 3. When it hits 3, you trigger a Hindenburg omen. So what are the conditions? The market needs to be going up, which it has been. Obviously, that's the first market condition. Number 2, breadth has to be moving lower. So as the market is going higher, you're getting this divergence underneath the surface of the market. Breadth divergence. Breadth is moving lower. Not all stocks. In fact, a minority of stocks are participating in the uptrend. The majority of stocks are going down. So you have somewhat of a breadth divergence there. And the number 3 condition is that the McClellan oscillator has to be below 0. And it was. So you had all 3 conditions present. That's why you triggered a Hindenburg omen. Now, historically, a Hindenburg omen does signal, downside to come in the major averages, benchmark average S&P 500. But you typically need a cluster of Hindenburg omens to trigger. So far, we just had the 1. Right? We don't have a cluster of them yet. The cluster happens within about a month's time frame. So just because we've triggered a Hindenburg omen does not mean doom and gloom for the market. It doesn't necessarily foreshadow that we've hit a peak But if we do fire several Hindenburg omens, a cluster, if you will, within the month, within a 30-day period, historically, that is a tremendously reliable signal that the markets are on the verge of consolidating, if not already in consolidation. So how do we get here where we're talking about breadth all of a sudden again? And why are investors so uncomfortable? Recall that late last year, November 3rd, we had a Zwig breadth thrust, and it was the second Zwig breadth thrust of the calendar year, for which has only happened one other time in history, and that was 1962. We had talked about this particular stacked chart showing 1962 into 1963 at the bottom, and where we were when that second Zwig breadth thrust, or ZBT, fired on November 3rd of calendar year 2023. And wouldn't you know it, just like the rally kept going into 1963, the rally has continued here in 2024. Do we anticipate it being completely analogous to 1962-63? No, that's not my expectation. But we should trust the thrust. We should lean into the probability that when you get a Zwig breadth thrust, it tends to be a powerful tailwind for markets going forward over the next 6 and 12-month period. In fact, 6 months later, after firing a Zwig breadth thrust, the market has never been lower than the date of the Zwig breadth thrust. 12 months after firing a Zwig breadth thrust, the market has never been lower than the date for where the Zwig breadth thrust was triggered. 100% positivity rate. I think this is either the 17th or the 18th Zwig breadth thrust signal in history. Pretty good sample size. Now, my S&P 500 target, as I outlined to Finom group members coming into the year, was that we would see the S&P 500 hit 5,200 at some point this year. Keeping in mind that, the Zwig breadth thrust carries with it not just a high percentage probability of forward positive returns, but it also carries an average of double-digit returns over that period of time. So for all Zwig breadth thrust, history tells us that the 52-week return average is 14%. So that would take us to 49.80. Well, we've already done that, right? So that's why they say, if you're looking for averages, averages is all you're going to get. But the median return is 17%, which we haven't quite gotten yet, but pretty darn close. Now, if you use all Zwig breadth thrusts going back to the Great Depression, sorry, the Great Depression, the average return is 22%. Median return pretty much the same. That would carry the market to 53.50 by November 2024. Remember, the initial signal happened on November 3rd, 2023. So a year later, knowing that there's a 100% positivity rate, there's the possibility 53.50, just using this particular thrust data. So my price target may be too low. Again, using averages, you get averages. The market can have a wide range of outcomes, as they say. Continuing with our breadth thrust discussion, we've heard a lot about, and it's validated by way of at least the Hindenburg omen, that breadth has been narrowing here in the new year, and it has, right? Small caps have underperformed yet again. Equal weight has underperformed yet again. And it's the Magnificent Seven making higher and higher highs. Meta new all-time highs. NVIDIA new all-time highs. Apple is hanging in there pretty well. Amazon more multi-year highs and on the verge of an all-time high. So your Magnificent Seven from last year still carrying the leadership baton into this year. However, with this so-called narrowing breadth, just last Friday, total stock market net new highs was the highest for the new calendar year and the highest that we've seen since the fourth quarter. More stocks are making new highs than stocks making new lows. And again, if you look at breadth this way, this is the equal weighted S&P 500 versus the S&P 500 itself. Now, it's not the equal weighted's fault that the S&P 500 is a cap weighted index, right? Because this is essentially showing a new all-time low, which gives credence to the idea that market breadth is not relatively strong relative to the cap weighted index price action, of course. Right? So you have equal weight basically at a new low relative to the S&P 500 itself. We've seen this mark tops before. Indeed, I'm not going to deny that. It happened in 2000, right? The dot-com bubble burst. It happened in 2007, which led to the great financial crisis. The market didn't cause the great financial crisis, but, the breadth underneath the surface of the market might have been signaling that something lay ahead, especially in that late cycle dynamic. 2020, same thing. Material underperformance in the equal weighted S&P 500 relative to the cap weighted S&P 500. Of course, it didn't cause COVID, but people will show those kind of charts and mark those moments in time as if they are precursors to the S&P 500, going into another bear market, which, keep in mind, folks, it would be the fourth bear market in less than 6 years, right? Bear market in 2018 during the fourth quarter, bear market in 2020, for COVID, bear market in 2022 during the fastest rate hike cycle since the 1980s. Really going to have a fourth bear market in less than 6 years? The odds are not favorable for that happening. Historically, actually, that has never happened. So is that really the probability you want to lean into, a 0% probability historically? Anyways, this is one way of looking at breadth and saying, hey, it stinks. However, it's not the fault of the equal weighted index that the S&P 500 itself has been so strong. It's a cap weighted index, and the Magnificent Seven have been fiercely strong even into the new year. But when we look at the equal weighted index on an absolute basis, look what we find, right? 52-week high. In fact, almost a multi-year high. It's at the highest level it's been since April of 2022. Nobody's showing this chart, right? That doesn't make for good charting on Twitter. You're not going to get a lot of, fans posting a chart like this, which is the reality. The reality is that most stocks are actually doing well. They are. You don't have to like it, but they're, in fact, almost at an all-time high. That's the reality, folks. It's amazing when you do a little extra homework, take the next step, so to speak. All right, what do we have here? So, in speaking of breadth, seen a lot of folks use the chart of the advanced decline line for the New York Stock Exchange to validate or invalidate the all-time highs in the S&P 500. First things first, folks, don't use one index's AD line to validate or invalidate a completely different index. Don't do that. That's just bad form when it comes to technical analysis. Number two, if we go back, go back in time. Let's go back to last year. At the bottom, we have the NYSE, advanced decline line, for common stock only, just stocks, okay? So it's the advanced decline line for the NYSE, and it was going down basically since mid-April through about late June, and finally started to rally. But here's the S&P 500. Again, using the same time frame from mid-April to late June into July, we can see that the S&P 500 did nothing but go up. In fact, it went from 4,150 to 4,500. So 350 points, all the while you had a breadth divergence using the NYSE advanced decline line. That's a lot of opportunity risk or opportunity cost that you are compounding. Imagine missing out on all of this because we had a breadth divergence. Can you imagine that? And here's the same thing. The NYSE common stock only advanced decline line peaked in late December of 2023 and has been in decline since. Yet the S&P 500 went from 4750 to 4950, another 200 points. You put both of those time periods together and you would have missed out on 12% in the S&P 500. Crazy, right? Who wants to do that? All right, moving on. Rate cuts, rate cuts, rate cuts. When are they going to happen? We will find out soon enough. We got a big CPI data dump today. And then on Friday, we get the PPI. So a lot of inflation data that could influence the Fed's decision-making process as we go into the next month, which will be their meeting month because there's no meeting in February. So with that, looking at the Dow Jones Industrials, it does well after the first rate cut. Also looking at the Dow, the sweet spot during the 4-year presidential cycle, the sweet spot should happen around June. I mean, look at this trend, folks. We've looked at cyclical charts like this in the past, and they've played out extremely, extremely well. So you might want to think about where you're allocating money come June, looking at history. Now, this is the average Dow Industrial performance for the 4-year presidential cycle, and we would be in this spot right here. That is a lot of upside potentially if the calendar plays out again or the cycle plays out again. We hit 5,000, folks. What's might be important here to consider is historically these millennium moments for the S&P 500 has resulted in pullbacks. When we first hit 1,000, the S&P pulled back. 2,000, the S&P pulled back. S&P 3,000 pulled back. The only one that didn't have a pullback was the launch from 4,000. Is that going to happen here at 5,000? We don't know. 3 out of 4 millennium achievements, found a pullback. So the odds are 75% probability we will get some degree of a pullback after reaching this millennium moment. Whole numbers matter. Algorithms love whole numbers. If you don't think that investors have set up their algos at these big whole number moments, I think you might be kidding yourself. All right, 72-day rate of change. So essentially, if we go back to the lows of the fourth quarter of 2023, 72 trading days later, the market gained more than 22% historically. And that kind of rate of change over 72 trading days, we look out 3 months and 6 months, the win ratio or the positive return probabilities are 100%, up another 6% on average and 9% over the 6-month period. It's a high win rate also if you go out 12 months. That's how strong this rally has been. Remember the breadth thrust, folks. Trust the thrust. And this is another data set that says even if we get an interim pullback, you want to take advantage of that by leveraging into the market. More from Wayne Whaley, the famous quant. February through December S&P 500 performance after you've gained 10% in the November through January period. No, this is not the toy barometer. The toy barometer only looks at November 19th through January 19th. This is taking the whole of November and through the whole of January. If you've gained better than 10%, which we did, gained 15.5%. So what I'm looking at is the February through August period, folks. 14-0. 14-0. Never a loss in the February through August period if you gain more than 10% in the November through January period. This is momentum begetting momentum. If you look from the February through the rest of the year, only one loss. Wouldn't you know it? 1987, of course, right? Black Monday, and it took a long time to recapture the former highs. But this tells you again, just like our former data set, you want to lean into the highest probabilities that there will be more gains to come. And yet another one, the latest one from Wayne Whaley, a 17-0 setup. You know what that means, right? 17-0. The next quarter, positive for the S&P 500 after the S&P has gained at least 2.5% in the December through February period, which we have. We're 10% higher February to date. More than likely, we will still have a 2.5% gain by the end of February, because this is December through February. Obviously, we haven't ended the month of February yet. We're halfway there. But more than likely, we're not going to lose, 7.5% here. So with that being said, if you look out over the next quarter, so the next quarter would be March, April, May. It has a perfect track record, 17-0. The market has been higher after the end of February. All right, healthcare. Healthcare has been our conviction investment thesis for 2024. We started, really solidifying our core holding in the sector ETF, ticker symbol XLV, late last year. We continue to trade around that core even here in the new year. But historically, what we were looking for was all-time highs in the healthcare sector ETF. We were looking for flows to go back into it. Why? Because we thought we set a reasonable base in the earnings for the sector, for which this year we would see pretty substantial earnings per share growth in 2024. And that, by all accounts, is already set to take place based on what we've seen reported in the guidance from the healthcare sector companies reporting this quarter. Now, with that said, we have seen an all-time high in the healthcare sector ETF. And what historically happens after that? Positivity percent rate going out 6 months later is 100%. So if you're in healthcare, it may not be over yet, folks. Historically, if you made an all-time high in the healthcare sector ETF, 6 months later, it was still even higher. A year later, 83% positivity rate. The only time it wasn't positive was after the dot-com bust. So if you're long healthcare, it might be a good idea to stay long healthcare. And while we're going over a lot of quantitative data and even technical analysis, what we also want to consider here, like I hear stuff from technicians all the time, right? It's in the price. It's in the price. Let price action be your guide. The technicals rule. Fundamentals drool. You got all kinds of technicians saying that, calling the fundamentals fundamentals. Look, folks, here's the reality. Buy and hold beats anything that technicians do. From a strategy concept, as a market participant, this is practical, okay? Keep that in mind. This is practical. I'm not saying don't do charting, don't do technical analysis. You see me do that here. It's in our macro market research reports at Finom Group. As usual, if you're not already a member, subscribe. We've got our next macro market research report coming out Sunday. You don't want to miss it, folks. With that, look, the best strategy for an investor is buy and hold. It's buy and hold. Market timing does not work. Okay? Trend following strategies do not beat buy and hold. Bloomberg tracks technical indicators going long when an indicator signals a buy and holding it until sell when short positions begins until the next new buy signal. All 22 models worse than buy and hold. All 22 models performed worse than buy and hold last year. Here's the thing. They always perform worse. You are never going to time it perfectly going in and perfectly going out using a technical strategy, folks. But if you thought in the past, well, technical analysis is the best form of analysis. It's more prone to momentum. It's more prone to the trend. It helps when it comes to getting out of the market before crash and things like that. No, it still doesn't matter. Yes, you might be able to get out of the market before a serious correction or even a bear market. That doesn't matter. The problem is getting back in. If you're trying to time things, you have to make two really smart decisions: when to get out and when to get back in. And unfortunately, most people don't get back in time. Hence, buy and hold. And here's just another chart basically validating the aforementioned here. Alpha from buy and hold strategy over the next 3 years. The darker colored bars are higher. than the active funds on an average, because most active funds are using some form of technical analysis. With that, I hope that you enjoyed our latest video. I hope you enjoyed the studies that we've outlined here for healthcare, for the market as a whole going forward. And I hope that this period of uncomfortability lends itself well, especially should we get some kind of a pullback. Why? Because let's face it, folks, the two most hated times to buy the market in history are when it is going up, because people don't like to buy what they think is the top, and when the market is going down because they're scared it's going to go down even more. The reality is, by default, the right time to buy is when you don't want to. Regardless of how good or bad breadth is, there's still only one way to get a return on capital, and that's to put capital to work. Have a great trading day, everybody, and come back next week. Come back next week. We should have our next video.